Thank you very much. Well, good morning, everyone. Thanks for turning up rather than sitting in your gardens on what looks like a fairly sunny day. Interesting times, to say the least, that we're living in at the moment. I think it was Lenin that said that some years nothing happens and some weeks years happen. And everything out there is moving fairly rapidly. It's hard to make definitive statements on what is going on, certainly in the banking world. There were talk about these loans that people are getting being declined, or you have to be on hold for an hour. We're seeing mortgage lenders changing this morning. I see the Halifax have only offering up to 60% loan to value. Surveyors are not going out there. So I think the chances of home movers moving in the near future might be quite slim. First topic I wanted to talk about today was personal protection. The sort of knee-jerk reaction when people do have fears, and sort of that might tie into the purchasing of toilet rolls. If you have enough toilet rolls to last you a fortnight, you can stop worrying about toilet rolls. And the same with cash flow, is that people look at their cash flow, will think, what can I cut back on, what can I pare back on? And one of those things might well be these insurances you took out some years ago. It's not really the right moment to be certainly looking at cancelling life cover and indeed your critical illness or income protection covers. If you needed to recommence something after cancelling it, then the odds are it might be more expensive. There might be more clauses in allowing you to take it out if you're older, particularly. So if you humanely can retain those for a month or two until any state aid kicks in, then please keep those in force. Most insurance providers are adding coronavirus clauses to new policies, so that if you apply for one and then keel over, you're not going to get a payout. So please keep hold of those if you can. As far as markets are concerned, we saw a bit of a bounce the other day, up a fair few percent. But then again, if you drop something with a great height, it generally just bounces a bit when it hits the floor. We're down again this morning a little bit, about 2%. The issue is that when commercial activity drops by possibly over a third, I gather 90% of construction activity has ceased, then you're going to see any sort of ability to value an asset reduce significantly. On the grounds of that if you can't actually work out what the value of something is, markets are going to gyrate somewhat as they try and find out exactly what a fair price would be. I'm hoping that we do see a certain amount of economic recovery, because we're not exactly laying a load of people off. This is not a repeat of the Great Depression when people were laid off and the economy is ground to a halt pretty much until the Second World War and, of course, FDR's New Deal. This should be different. We should be able to recommence economic activity. Most economies are driven these days by consumption rather than making stuff. And so as soon as people get out there and start consuming again, we'd hope to see the economy pick back up. What that actually means for taxpayers when the government has sort of printed all this money that they haven't really got, it's kicking the can down the road. What long-term economic impact will have, one can't necessarily define. It will certainly mean that the risk of inflation is heightened over the longer term. And that is perhaps another reason not to sell assets into cash if we are going to see inflation pick up in a year or two down the line, because of the fires being stoked from this occurrence. In terms of what you do with your money, if you have invested it, then leave it be. If it was good enough for you a year ago, it's good enough for you now. Selling down means you're actually making a loss. If it's a paper loss, it's only a paper loss until you take it out. It's only a paper gain until you take it out. If you have got spare money, I haven't come across many who have, this may prove to be a once in a lifetime opportunity to make a good return. I remember during the financial crisis, somebody coming in and for once wasn't screaming about the fact their money had gone down by 40% or 50% in some cases. It was somebody saying, well, how much has it gone down? Well, you lost about 80 grand or something. And he took his checkbook out. He said, buying signal. People with that amount of courage and spare money will be making a killing during this period. I don't think there are many folk out there that A, have that sort of mentality, and B, have that money. I spoke to somebody a week or so ago who bemoaned the fact he hadn't got money spare to invest at the present time. And he was very sanguine about his volatility. He said it's cyclical. It's just a bit worse than cyclical because of the effect of this novel pandemic that we're not got an immunity to. But these things will sort themselves out. They always have, unless you think that this pandemic will rip open the fabric of capitalism and the capital markets. These things will recover. The important thing at the moment is not necessarily to worry about investment values. It's to worry about keeping yourself safe, your family safe, wash your hands, try to come down with this while the NHS is under so much strain. And with this lockdown will lead us to have a certain amount of dampening down of this spread, and the world can go back to normal a bit more rapidly, with perhaps occasional retreats into social distancing, or keeping it up while we're waiting for a vaccine. So that's sort of the summary of it. It's very hard to summarise things that are fast moving. I think the key point for me is to make sure that people are keeping what they've got going, making sure that if you have got I'm sort of treading on the mortgage advisor's toes a bit, but lenders are not letting you switch to a different product if you are on a payment holiday. So if you go up your deals up, then switch on to a new deal first before asking for a payment holiday. Those standard variable rates are still high. Clydesdale just cut their rate this morning from sort of 5 and a bit to 4.6 or something. So there's a degree of sense in not lurching yourself onto a standard variable rate, being stuck on that for a period, and sort of technically paying that and having it added to your debt to pay down the line. So talk to your broker, talk to your advisor before you start talking to a lender, just to make sure you get it right. Lenders are acting with a degree of responsibility about payment holidays. There are ways of doing it online. Most of us in the business have got online links for people to apply, because of course their phone lines are remarkably busy because a lot of people are not going into the office. And so consequently, talk to your advisor. And I'm here to take, you don't have to be a client to get in touch with me. Drop me a note, drop me an email if you've got any personal questions or issues thereof. I don't think I've got anything particularly to add that's definitive. I mean, what I was interested in doing is opening the floor up and seeing what people have to say that they perhaps wanted some peace of mind over, had questions that they wanted to share with others that they thought others could benefit from.
Yeah, I'll kick it off to start off with. I've got at least one other comment or question. And you guys, if you've got a question, I'd say just put Q in the chat or raise your digital hand if you know how to do that. So if someone's investments are primarily now in the money market or gilts or things like that, is it wise to start shifting those and investing in the stock market while the stock market prices are low?
I'd take the view that if you went to the money markets at the right moment, which is before it all happened, it's probably because you were frightened. And are you going to turn yourself into a gibbering wreck by transferring the money when volatility is likely to continue for some time yet? I don't think they're going to see a V-shaped recovery. You might see a W-shaped recovery, because the odds are this will not cease until we have the right medication, the right vaccine. So the odds are this could spike up again when people go back to work, which could cause another panic. Uncertainty is not a friend of markets. Markets survive on greed and fear. If it were me, I would be keener to put the money in the markets now while they are on their knees. And yes, you might see some further reductions, but money market returns are going to be zilch. Mm-hmm. There's also the cost of holding it. I mean, if you're putting it through a platform, for example, the platform's going to charge you for holding that asset. If that asset's making you no money, you're actually having money scraped off you by the administrators for the administration costs, and yet with zilch chance return. And if in the longer term cash is always eroded by inflation, if you don't need access to that money within the next 4, 5, 6, 7 years, then why would you leave it in cash?
Okay. And is gilts a good market to invest in? Because presumably the government's going to have to raise money to fund all this stuff in some way, shape, or form. So
Well, they might well just raise gilts and buy them back off themselves, which is what they did during the start of the financial crisis.
right.
The thing about gilts is that if you are taking zero risk with your money, you will get zero return on your money.
Yeah.
And that is why gilts tend not to be part of a portfolio unless they're index linked.
Okay.
So that's the key point about gilt edge stock. It's great in terms of you're not going to see a capital loss, but you're not going to see any return either.
And again, if you've got a certain amount of your investment in an ISA, is it best to leave that there for the time being?
Well, why wouldn't you have it in an ISA?
I don't know. I'm asking you.
The point of an ISA is to protect yourself from tax. Well, at least capital gains tax and income tax.
Yeah.
At the moment, most ISAs that were invested over the last couple of years wouldn't have a capital gains issue anyway. But certainly, if in the future you're going to you want to use that money to supplement your income, then it's nice to have an income that's being supplemented by something you don't pay income tax on.
Okay.
You don't pay income on any yield you get within that wrapper as well. So that tax wrapper, that ISA, means any return you get in terms of dividends, in terms of yield on stocks or rent from a property investment, is free of income tax as well as CGT. So why wouldn't you retain your ISA?
Okay, well that segues into James Blacklaw's question. So James, I'll unmute you to ask your question.
Yeah, thanks, Paul. A similar question I asked someone the other day to Stephen. A relatively low-level investors, like I guess most of us are, who don't have hundreds of thousands to play with. I asked a question about stocks and shares ISA, as I used to call it, a maxi ISA. With the market kind of on its arse, I felt it's probably a good time just if you've got a few quid which you're not needing for the next couple of years, it's a good time to chuck into it. And I did that this morning. Just put a few quid into a stocks and shares ISA. I mean, have I just made a bad decision by doing that, or do you think that in the long term will prove to be a sensible decision?
So long as you're not expecting to access it in the near future. Most investment returns are made by the compounding of what you get from holding those assets. All these graphs we see on the news, the FTSE index and that sort of stuff, all it is the paper value of the shares. It is not counting the dividends. If you look at the return on investment, it's all about the yield you get from it going back in the pot and being compounded. And so most investments have got to look at a 5 to 7 year time horizon to get the benefit of that compounding effect. If you don't need access to that money and you're prepared to watch it gyrate a bit over the next year or two, then you might well find that you've made an extremely good decision by putting it in now.
Yeah.
Because that certainly was the case during the financial crisis when people were panicking, taking money out and crystallising a loss. The people that put money in were, there was a chap I saw, I think 2009 possibly, he put 50 grand in, and I remember his wife rolling his eyes at him, and he said, "Oh, it's only money, love," and that pretty much doubled in 5 years.
And helped him pay for his divorce.
No, they're still happily married. They're still clients even now. He was a fairly again. It's back to how savvy you are. He worked at Reuters before he retired, and followed markets as part of his job, getting data together for Reuters. So he'd got a fair idea that if you're better off buying something when it's cheap than buying something when it's expensive.
Yeah,
and that's what he did. Equally, he put money in before the financial crisis and lost his shirt on it, but he had that degree of nerve to hold fast, and he held fast on the whole lot. And I haven't checked his balance recently, but he's still going to have made a damn sight more money by doing what he did than he would have done any other route.
Okay, does that answer your question, James? Got any?
Yeah, that does. Thank you, James. I've got one more, if that's okay. If you,
no, well, seeing as it's you, Mr. Blacklaw, of course.
Seeing as it's me, as all these things, one of the first things you learn when you go into banking is about diversification of risk, and obviously it's something you practice for your clients, which is great. But the other thing I want to ask your opinion on, James, is things like premium bonds and precious metals that kind of thing, which wouldn't fit as part of a kind of a traditional investment portfolio necessarily. But obviously premium bonds are a guaranteed income. Precious metals are sort of a traditional, guaranteed income, guaranteed return. You get your money back from premium bonds. And precious metals obviously a very traditional way of investing. But now I've seen the price of gold has kind of crept up a little bit in the last sort of, well, silver seems to have done that. But just wondering your view on those as a long-term investment.
Gold is a insurance policy.
Yeah.
So you'll find that a lot of portfolios, and certainly the DFMs I use, will include physical gold ETFs as part of the portfolio, moving up to 10% recently. The Jupiter Merlin portfolios, which I've used for years, will contain physical gold as an insurance policy. The difficulty with physical gold, again, you are getting no yield.
No, that's right.
Nothing to compound. If you do look at the gold price and it's available online, it actually went down during this period. Mainly because people
checked it for a week or so.
Yeah, I mean, it might have picked up over the last while. I don't tend to peer at gold a great deal because it's not. It's something there to provide a hedge, because when everything else goes down, generally gold goes up. Weirdly, this time around it didn't. Probably because people were unwinding various positions. They were lacking liquidity, and so an awful lot of speculators were caught with the trousers down with this hit. And so hence that's why gold went down and the dollar went up and all this sort of strange behaviours. I wouldn't see that gold is a particularly good investment. You might wish to read Warren Buffett's opinions on gold as an investment, because he's a more successful investor than I am. He certainly takes a dim view. Going back to the financial crisis, which I'm still sort of scarred by, gold was a hockey stick up until that point. It's flat, and then it went up when everything else was poor. It's quite pretty to have some gold jewelry or whatever, but it's not a good long-term return. What it might do is act as a store of value. I think there was some statistic I was reading some time ago about how if you took the amount of gold that you needed to buy a suit of clothes in 1580, you could the same amount to buy a suit of clothes now. So it's a sort of a store of value, but it doesn't make a return.
It could be part of a balanced kind of portfolio, but you wouldn't rely on it to grow over a sustained period of time.
I wouldn't rely on it to beat the cost of living. It might hold its value in real terms, but because you're not compounding a return, you're not going to get a real return.
No.
So the point of gold in a portfolio is an insurance policy.
Yeah. Thank you. Listen.
Cut down on your bling then, James.
I do buy silver on a regular basis. Can't really afford to go gold, and it's one of those things I get mixed views on. But you're right, it is quite pretty. I do quite like looking at it. Yeah.
Okay, Midas, thanks. So anybody, I'm going to unmute you all now. We'll see what happens when we do that. So does anybody else have any questions for James Tarry?
Yeah, James, Roger here.
Hello, Roger.
Yeah, you got some good advice here. Talking to a lot of clients, or they're calling me, particularly about the mortgage payment holiday.
Sure, yeah.
I'm finding banks are being quite sympathetic, if that's the right word, and they are making it quite easy. But
they're obliged to be sympathetic, aren't they? That's it.
Well,
the FCA says you've got to be sympathetic.
Yeah, absolutely. But I've had to warn some people, don't just cancel your direct debit. You've got to notify the bank that you're struggling or you want to make use of the payment holiday, and then wait for confirmation that they can do that before stopping your direct debit mandate. But but then also just coming into the investments, I've had a few folks this week contact me looking to, rather than pull money out of their investments and the pensions, to actually make use of the low cost of borrowing at the moment. Up to the first part of this week, you could get trackers under the 1% mark, couldn't you? And it is cheap, the borrowing, rather than looking into your investments. It's not right. It's not the right thing for everybody, but for some situations, it's probably worth a consideration.
I think it's down again to an emotional response. My personal view is if you put all your money into one asset class, i.e. property, then that's a concentrated risk. It's even more of a concentrated risk if it's property in one part of the country in one type of property.
Yeah. So
having started my career during the housing market crash of the late 80s, early 90s, again, property is a useful diversifier, but it's hugely tax inefficient on a number of levels. And so I think the people that are going into property are often those who are, it's their comfort zone rather than for practical reasons.
Yeah, I agree with that.
Is this payment holiday on mortgages, is that just for personal mortgages, or does that apply to
buy-to-let as well?
Yep.
Because there are tenants not paying.
Okay.
So how does a buy-to-let landlord cope if the tenants aren't paying the rent? So yes, buy-to-let landlords can apply for payment holidays as well.
Okay, and it's 3 months, is that right?
Well, it's going to be how long this lasts.
Okay.
Just remember that it is added to your debt. You know, they're not letting you off.
Oh no, of course. But is the standard 3 months, or is it down to the lender, or down to what you negotiate, or? I
think some of it's going to be down to the negotiation. I think 3 months is considered to be time enough to work out what the hell's going on, and what sort of impact this is. But I'm certainly not. The longer you leave it, the more the debt you got.
Yeah.
But I don't know. It depends on how long these tenants, self-employed tenants particularly, are the ones that are particularly suffering. Theoretically, they can go off and get housing benefit, but if you try to access the universal credit systems at the moment, there's a wave of demand, and so of course that's fallen over. It's not that easy. In principle, it's easy. In practice, it's not.
Okay. Any more for any more? I think your work might be done here, James. So very informative. I think that was really useful. Thanks again for those that have tuned in today. And this will be available as a recorded webinar at some point when I've edited all the crap out and put it online. So thanks again, guys. We've got another one. Who's on? So James Blackclaws, you've got one at 3 o'clock. So
tune in, guys.
Let people know what you're going to be talking about.
I don't know yet. I'll be talking about.
How reassuring.
It's going to be a good one. And the government's Corona Business Loan Interruption Scheme. Why it was set up. My kid's throwing a football onto the ceiling.
I blame the parents.
Yeah, so do I, actually, to be fair. I'm in the conservatory and it's got a perspex ceiling, so it's smashed on top of that. So the Corona Business Loan Interruption Scheme, why it was set up, the criteria for it, eligibility for it, and the truth in what's actually happening since it's been set up from the banks and from clients. Okay, thank you very much. And Margot, you're tomorrow morning, aren't you, 11? Do you want to let people know what you're going to be covering?
It's all about cash flow, tips on how to manage your cash flow, things to do, things not to do, and basically don't panic. Okay, all right, which I think was James Tarry's message pretty much. So thanks, guys. See you online at some point in the future.